A distinctive feature of all mechanical trading strategies is the presence of a set of clearly formulated rules, according to which trading is conducted in the market. System or mechanical traders do not take part in market situations that are clearly not subject to their set of rules, but at the same time take each of their trades if the conditions for the transaction meet their requirements. Intuition, beliefs, and experience are not taken into account. Mechanical trading strategies can be programmed and tested on historical data. If you are a supporter of the system style in trading, then the use of proprietary trading strategies studied in this video course is your choice. However, as part of this video series, I would like you to explore an alternative approach to making trading decisions. Let's consider an example of discretionary, or, in other words, a non-mechanical approach to trading, using proprietary intraday trading strategy as an example. What is the peculiarity of the discretionary approach to trading? Here, the trader monitors the market and prepares to enter the trade in case of one of the standard setups. Position entry point, take profit, stop loss and size depend on the current market sentiment, which the trader evaluates based on his experience and thanks to the skills of seeing a broader market perspective. The discretionary strategy offered in this video is essentially the proprietary methodology for determining, or in other words, identifying the most likely scenarios of intraday price dynamics. Any financial instruments with good volatility and sufficient liquidity are suitable for trading by this strategy. To analyze the current market situation, the strategy uses several time frames. Short time frames, such as 5, 10, 15 minutes, are used to determine entry points to the market. Medium time frames, such as 1 hour, are used to determine the most probable range of price fluctuations within a day and to place take profit and stop loss orders within this range. Long time frames, such as daily, weekly, monthly, are used to determine important levels of support and resistance, as well as assess a broader market perspective. The main analytical tool for this strategy is the ADV indicator. With its help, an assessment of the probability that a certain price movement will occur within the day is made. Additional indicators of the strategy are the moving averages SMA 200 and EMA 200. The main idea of this intraday strategy is as follows. Trader must determine the mood of market participants in the selected segment of the financial market, and in the case of a noticeable shift in the balance of power towards bulls or bears, draw up and evaluate the probability of developing of the corresponding trading scenario, and then open a position on the instrument where it is a possibility to ensure a profit-loss ratio favorable for a trader. In order to determine the mood of market participants, two proprietary analytical tools are used. First is a technical profile of a financial instrument. Second is a market participant's balance of power chart. Let me remind you that we talked about them in the previous modules of the video course offered within the framework of GMT Partner Project. When making a decision, as a rule, from 5 to 10 factors are important. This is what Ray Dalio, the famous American businessman, billionaire, and the founder of the Bridgewater Associates hedge fund, says in his book. He recommends that this rule be well learned since the ultimate usefulness of learning even important things after a certain point is very limited. In this sense, when developing this intraday strategy, I decided that it is not necessary to focus on an infinite number of different factors, losing sight of the really important things. I limited myself to the following factors. 1. There is a favorable market sentiment which is calculated using the signals of the proprietary trading strategies. 2. There is a target level on the chart, without visible obstacles in front of it, which provides a favorable profit-loss ratio for a trader. 3. There is a protective technical barrier, in the form of a resistance or support level, or MA 200 moving averages, which allows a trader to place a stop-loss order in line with the limits of risk. 4. There is a price movement with an amplitude from 1/4 ADV to 2/3 ADV of the selected financial instrument, depending on the time of the session, which is directed against the expected market impulse. 5. There is a catalyst in the form of a fundamental factor that has a significant impact on the market. Some additional analytical tools may also be useful in determining the most probable scenarios. As for me, first of all, I pay attention to bigger time frames, such as daily, weekly, and monthly charts, where I find support and resistance levels, candlestick patterns, graphical patterns, Fibonacci levels, technical signals generated by oscillators, such as divergence and some other things. All these are technical signals confirming a change in the market towards a broader perspective. I also analyze the dynamics of open positions in the futures market from the weekly commitment of traders report, which confirms the mood of market participants in the long term. Trader needs to know when he has an advantage and when he doesn't. And if at some point there is no advantage, trader just needs to move away from the charts. If a trader is sitting in front of the computer screen, desperately trying to find the entry point, then most likely he will open a position with a low probability of a favorable outcome. In other words, this means that in such a situation, trader risks his money, having a very low chance of making a profit. A professional trader knows that a new position has to be opened only when there is a low-risk opportunity, just as a professional poker player, who gets a third ace on the flop in addition to his 2 aces, should keep playing and betting. Conversely, when a poker player is weaker than his opponent or when he gets weak cards, he must quickly fold those cards to save his chips for the best hand. The goal in trading, as in poker, is to manage the capital or trading chips correctly so that you do not lose too much due to the influence of emotions or weak hands. Therefore, when strong hands come to you and there is a high probability of a favorable outcome, you will be able to earn a lot of money. Thus, when identifying the most likely scenarios of intraday price dynamics, the first priority of the trader is to analyze the balance of forces of market participants within the selected market segment. To do this, it is necessary to fix the presence of formally open positions for each instrument that is part of the selected market segment. As you must remember, all positions opened by the rules of the original proprietary strategies, both formal and real, are fixed in the technical profile of the financial instrument. Further, having determined a financial instrument that shows a noticeable advantage of bullish or bearish sentiment, and from the point of view of technical analysis tools, provides a good opportunity for a trade, it remains to decide on technical parameters of this transaction. In other words, it remains to find on the chart the optimal levels for opening and closing a position that could provide an acceptable level of risk and an attractive profit-loss ratio. I think it's not a secret to anyone that the price in the market moves from one price level to another. In this sense, the task of any trader who works according to the rules of the intraday trading strategy will be to wait for a favorable moment, when the price completes the corrective movement or counter move bumping into a strong level of support or resistance, and then turns around and becomes ready to start a new momentum in the opposite direction. Depending on the current market situation, trader can prepare himself for the following scenarios of intraday price dynamics. Bullish scenario involves the opening of a long position after the end of the corrective downside movement. Bearish scenario involves the opening of a short position after the end of the corrective upside movement. No trade scenario, when the market develops a situation that is unfavorable for opening any positions. An alternative scenario, a market situation where it is possible to implement first a bullish and then a bearish scenario or vice versa. In order to define probable scenarios, first of all, traders should use the volatility parameter of the selected financial instrument and several other analytical tools. As I said above, Each of my trading strategies uses a special indicator ADV, which allows you to determine the average amplitude of fluctuations in the price of an instrument during a trading day. Using the currency pair Euro versus US dollar as an example, I will show how I use this technical parameter of a financial instrument. Suppose we know that the average daily volatility of a given currency pair is 100 points per day. With the start of a new trading day, at 21:30 Greenwich Mean Time, a new daily candle starts to form on the chart. At first, it looks like a small horizontal line, and then the body and shadow of the candle begin to form. After 24 hours, the formation of the daily candle will be completed. We don't know what shape and size the new candle will take. We don't know whether it will be bullish, bearish or neutral. However, despite this, we can calculate the approximate range of price fluctuations during the new day. If the price keeps rising all the time since the opening, then most likely it will reach 1.3100 price level. Similarly, if from the opening the price keeps falling all the time during the day, then most likely it will reach 1.2900 price level. However, a more likely scenario is when during the day the price first makes a counter move and then starts moving up or down. No matter what the fluctuations will be during the new day, their amplitude most likely will not exceed 100 points. Awareness of this fact and the balance of power of market participants on different time frames will help the trader to find on the chart the areas that are attractive for entering a position and placing in order to limit possible losses. In practice, when using MT4 or MT5 trading platform, you can apply a special grid which is shown on the slide, very like the Fibonacci grid, to determine the likely range of intraday price fluctuations. In the case of the bullish scenario, you should set the zero value of the grid at the maximum of the current trading day. A long position should be opened in the range from 12.5% to 66%, and a stop-loss order should be placed in the range from 50% to 100%. Having determined the price level or the price range, about 25 to 33% ADV of the selected financial instrument, which is favorable for opening a position, you should move the zero value of the grid to this level or the middle of the range. For a pessimistic scenario, the target, upon reaching which the trader will need to close the position, will be 66% mark on the grid. For an optimistic scenario, the target may be the furthest mark on the grid, that is, 100% or the nearest technical level on the chart beyond the 100% mark. In the case of the bearish scenario, you should set the zero value of the grid at the minimum of the current trading day. Now, we can move on to the last point of the presentation. Let us summarize and bring all the elements of the methodology into a single whole. Let's consider the algorithm of actions of the trader in the course of work according to the trading scenario defined in advance. The first point of the algorithm is to determine the profit-loss ratio of the transaction. This is a kind of filter to filter out transactions with an unfavorable ratio of potential profit and risk. To trade within the day, trader should choose only those trades where the profit-loss ratio is at least 2 to 1. Next, let's consider the actions of the trader when opening a position. First of all, in order to open a trade, the price of the financial instrument must enter the position opening zone. Trader can place limit orders in advance to open a position, as well as stop loss and take profit orders. On the other hand, if the trader is ready to track the price reversal in the specified zone in real time, then he can open the position immediately after the reversal, at the current, possibly better price. In this case, the next step of the algorithm will be placing of stop loss and take profit orders. It is necessary to do it immediately after the opening of the position. A signal of a price reversal will be a filter of 10 to 15% ADV or the formation of the candlestick patterns presented on the slide below. As the price moves further in a favorable direction, trader should hold his position until the price reaches the target zone. If at the end of the current trading day the price remains between the target zone and the break-even point, trader has two options: either close the position at the current price, or leave the position open, and change the ordinary stop-loss order into trailing stop, which should be 1/2 ADV away from the latest extreme price.